I want to take a look at some candle patterns that you could use as signal patterns. But what I want to show you is a really simplified version of this. We can boil all of the different candle patterns down into two basic patterns. We're looking for an engulfing pattern and we're looking for a small bodied candle, generally followed by a confirmation of some kind. I'll show you both of these. When we have a market that is moving down, what we're going to look for is a bottom. Now, this market that moves down, it could be an overextended, oversold market. It could be a pullback in an uptrend. Whatever the case is, we're looking at the bottom of this market movement. So what we'll see is a market that moves down, printing some candles. These are going to be bearish candles as this market moves down. Now, towards the bottom, we're going to get one bearish candle, and the engulfing candle that follows is going to be a candle that is bullish, that is bigger than the body of that previous bearish candle. It is going to engulf that entire previous candle's body. So this would be the first candle, and then this would be that second candle. We've got that bullish engulfing candle, and I want to take a look at that on the real charts. Now, we've got some nice patterns in here, but I want to see something that is super clear, something that is going to be unmistakable. So what we're looking at is an area like this. Let's zoom right into this. We're seeing this bottom as the market is moving down. We have the price dropping down as the market is making a pullback in this bigger uptrend. So the price is moving down. It prints this bearish candle. So this gray candle is a bearish candle in the downtrend. And what happens next is we are followed by a bullish engulfing candle. This candle's body is bigger than the previous bearish candle's body. So we've got a bullish candle that is showing us there is more upward market momentum now at the bottom of this market move. You can see during this whole downtrend, this whole move down, we don't have any bullish candles that do anything like that until we get that reversal area. Once the price gets to the bottom of this market movement, we'll see this bullish reversal candle. This is called a bullish engulfing candle. This is one of the most basic patterns that you'll find, and a lot of traders use this pattern. Let's take a look at this on a market that is moving up, and we're looking for a signal to go down. Now, let's take something again that is really crystal clear. We see that right in here. We have a market that is moving up. So we'll start at the bottom. This market moves up, and it's topping out in this area. What we have are lots of different bullish candles. We print this one candle here that is a bullish bodied candle. This following candle is a bearish engulfing candle, as the body of that candle is bigger than the body of that bullish candle that came before it. So what we're seeing is the market momentum possibly turning. We've got this momentum to the upside. We've got this bearish candle right here, this engulfing candle, showing us that momentum to the downside may start taking over. And if we look back, we don't see any kind of bearish candle that does the same thing until we get to this reversal point. This is a very bullish market, and as soon as we get that bearish symbol in here, we see that the market does want to pull back. Now, this pullback is a pullback. It's not a reversal, but it does show us that the momentum is now towards the downside. So we've got this bullish engulfing and we've got this bearish engulfing, and this would be a bearish engulfing candle. The next one we're going to look at is a 3-bar pattern. It is still an engulfing pattern, but it uses 3 candles instead of 2 candles. All right, so we take a look at this area right in here. We've got a bullish pattern. This is called a 2 inside up, and this is also an engulfing pattern. I'm going to zoom in so we can see this a little better. What we're looking at is 3 different candles. In a downtrend, we've got the market moving down, and it's printing all these gray candles. We get this one gray candle that prints. This is the first of that 3-bar pattern. The second is a white candle that does not engulf that gray candle. We do not have an engulfing pattern yet. At this point, it's not really anything. We don't have any kind of pattern. But candle number 3 prints, and with the combination of candle number 2 and candle number 3, we get an engulfing pattern. Those 2 candles combined engulf that previous gray candle. So this is another variation of that bullish engulfing candle. We have one bear candle, we get one smaller bull candle, and a second smaller bull candle, but the combination of the 2 bull candles is more than that bearish candle that came before it. So now we're going to take a look and find that in the other direction. And here we see a couple nice examples of that. We are looking at a market that is moving up. So what we're looking for is a 2 inside down formation. That is 1 bullish candle followed by 2 bearish candles. Now this one doesn't yield a huge market movement, but we get the idea with this pattern. We have a market that moves up. We get 1 white candle. It is followed by a smaller gray candle, and the combination of that and the second gray candle gives us an engulfing pattern. These 2 candles combined engulf that initial white candle. Again, the market moves up. We're seeing this white candle followed by a gray candle that at this point doesn't mean a whole lot because it is smaller than that white candle, but the following gray candle plus that initial gray candle, the combination of these 2 candles is greater than that previous white candle, and the bodies of these 2 gray candles engulfs the body of that white candle. And again, we see the market continue to move down. We have these 2 different kinds of engulfing patterns that are very powerful. They show us where the tops and where the bottoms of these market moves often are. And from here, we're going to move on to something called a small body. Now, there are lots of different small bodied candles, but all you really need to know is the fact that after a market move, you're looking for a candle that has a small body on it. It doesn't matter if there's a huge wick on the body. It doesn't matter what side the wick is pointing out. It doesn't matter if there are any wicks. What we're looking for is a disproportionately small candle after some larger candles after a market movement. Now, we've got 2 examples of that in both directions in this little window here. So the first one is right here. We've got a market that is moving up, making these big white candles, and then we have this white candle right here. It forms a very small body. Now it has a longer upper wick, but this body is much smaller than the previous candle's bodies. It is showing us that even though the price tried to move up, it came right back down. We have some really good downward momentum. And if there is no wick, it just shows us that there's no more upward momentum. So what we're seeing is this one small bodied candle. And what we're looking for is a confirmation. So we have this small bodied candle followed by a candle that is moving in the direction we want it to go. So we have this market moving up, topping out. This confirmation shows us that the market now wants to continue to move down. So we get this market move down. Now over in this area here, we see that the market has continued to move down. It prints this small bodied candle, and the following candle in this case happens to be an engulfing candle, but it does follow this small bodied candle. So we see this small bodied candle showing us that this market movement is potentially done moving down, and it prints a small body. And it just shows us that there's a failure in this momentum, that the market just struggles now to continue to move down. And we get that confirmation candle as that candle changes direction and prints in the direction we want the market to go. Now, it does not matter what color these candles are. If you have a market that moves up and it prints a small bodied bearish candle, that's fine. If the market's moving down and it prints a small bodied bullish candle, that is fine. We see that again right in here. We've got a market that moves down, prints this very small bodied candle. It's a doji, but that still qualifies. The body is still very small. And then it follows with a confirmation candle. This confirmation candle shows us that that small body really did see the failure of that downward momentum, and the market reverses as a result. So if we're looking for these candle patterns, all you have to remember is 2 different engulfing patterns and a small bodied pattern. I just want to make this really clear. These patterns are meaningless unless they happen at what you want to consider are significant levels. If you've got a sideways market and it is very range bound, and let me find that. We've got a sideways market in here. So right in the middle of the chart, we see this market chopping around. It's very sideways. It has no direction. It has no momentum. We are going to see a ton of different candle patterns show up in this sideways range, and none of them are going to mean anything. We've got a bullish engulfing candle here. We've got another bullish engulfing candle here. We get a bearish engulfing candle here. We get a bearish engulfing candle here. Bullish engulfing, small bodied candle up here. Bullish engulfing down here. We've got all of these different patterns in this sideways market, and nothing comes of that. We don't have any market movement because of these candle patterns. That is the nature of a sideways market. You want these patterns to happen at significant levels. So what would a significant level be? A significant level would be areas of support and resistance. If we're looking at this one, we have this really nice area of resistance. The price has moved up, printed this little bodied candle. The price continues to move down. As this market continues to move, it comes back into this area. And we see that it has a small bodied candle, and it's followed by a bearish engulfing candle. Because it's at this significant level, we can put a lot more stock in this bearish engulfing candle because we are being rejected off of this level. Now, other areas that you could look at are Fibonacci retracement zones, and you could be looking at areas that are bouncing off of moving averages. So if we take a look at a Fibonacci retracement, for example, we've got a couple of them right in here. I'm going to use my Fibonacci tool from the bottom to the top. We zip that over. We can see the price has retraced into this Fibonacci window. It gives us this very small bodied candle with a confirmation bull candle. This becomes a very reliable signal because of its location. Now, if we move this over and we look at this next swing, so I'll just reconnect the highs and the lows. We have this big push up, the market pushes down, and we get this 3 candle pattern right in the middle. We have that engulfing pattern. That's the 2 inside up. So we've got this gray candle followed by 2 more white candles that engulf that gray candle. So we have this at a very significant level. Now I'll throw a moving average on the chart and we'll see what that does. We're just going to use the standard 34 EMA and we can see how that will work in a scenario where you have a trend based on the moving average. You've got the market pulling back into the moving average. We get that candle pattern in here. Market moves away, comes back into that moving average. We get a candle pattern in here. Now with the moving average, we have more ability to see when a market is overextended. So when we look at a market with a moving average, we get an idea of the fact the market can be overextended as it moves far away from that moving average. And we could be looking at a candle pattern that may signal a reversal back to that moving average. And here we get 2 of them. This is a bearish engulfing candle as we get an overextended market. Again, the market is overextended down here and we get another bearish engulfing candle. And both of these result in market movements back towards that 34 EMA. I hope this video is helpful, and now you can see candlestick patterns in 2 very simple pattern types.